One word that best summarizes the latest flow of news is mix. The economic news was mixed yesterday. The corporate results were mixed, but a light guidance from Microsoft was a major takeaway from yesterday's crowded headlines, and well, it could actually mark the beginning of some profit taking in AI related stocks. Now, more big tech results will hit the wire later this week, but first, the Fed. So welcome. This is Swissquote's Daily Market Talk. So I have some good news, I have some bad news, and news that are fundamentally good for the economy and bad for the global interest rate cut expectations. So I will start with the fundamentally good news. So the good news is the European economies actually performed better than expected by analysts last quarter. So this does not mean that they did well, mind you. It just means that the European economy surprisingly avoided a recession in the final quarter of last year, and it is already good news per se. And it is also said that it is the European version of soft landing. The fun fact is, the flat European performance is thanks to a relatively better Spanish and Italian growth and not the German numbers, because, well, the German economy, which used to be the European growth engine, remember those days? Well, contracted by 0.3%. So zooming out, the IMF raised its global growth forecast from 2.9 to 3.1% for this year, saying that the strong US economic growth and stimulus measures in China should show in better growth numbers for this year. Yes, but the latest PMI numbers from China show that manufacturing in China shrank for the fourth consecutive month, and the China's CSI 300 index already gave back all of its gains that it accumulated on last week's long series of stimulus measures and news. So the China story remains in limbo, in my opinion. Anyway, now let's come to the bad news. The bad news is these good growth numbers in Spain came along with an unexpected jump in the inflation numbers as well, and more Euro area countries will be releasing their own inflation figures today. And well, given that the growth numbers in the Euro area were better than expected and flattish, a set of stronger than expected inflation data for the Eurozone countries should actually throw a floor under the Euro's weakness simply by weakening the European Central Bank those hands. So the Euro, which partially reversed yesterday's losses against the US dollar, is still under a decent selling pressure this morning at the time I'm shooting this video, with a crowded resistance into the 200-day moving average, which stands near the 108.40 level. But note that the current market pricing suggests a 75% chance for an April ECB cut, but April feels quite early with the upside risk building for inflation. So in terms of Euro's pricing, it means that an uptick in inflation figures in the Eurozone could help the Euro-dollar go back above its 200-day moving average level. But all that will obviously depend on what the Fed will say as well, because a sufficiently dovish Federal Reserve could actually pull the US dollar lower, help the euro strengthen, and a stronger euro against the US dollar would temper the energy-led rise that we see in inflationary pressures and allow the European Central Bank to act sooner rather than later. And the same reasoning applies to all of the other major central banks that are not the Fed. A softer Fed and a cheaper US dollar are only good for global inflationary pressure. So this is why the Fed decision matters the most for all of us, and this is why we can't stop thinking and we can't stop talking about the US Federal Reserve. So what the Federal Reserve will do and what the Federal Reserve will say is important, and happily, well, we won't wait much longer before finding out what they think in the US about all this. So the Fed will announce its latest monetary policy decision today, and Jay Powell will tell investors about his version of where things are going a bit later than the rate decision, which is expected to be kept unchanged. So data-wise, we had a mixed bag of news from the US as well, both in terms of economic data and corporate results. So the good news for the US was that the US job openings increased in December, so more jobs were actually offered to people, which is obviously not cool when you helplessly want this US jobs market to loosen so that the Fed could cut the interest rates sooner rather than later. But the good news is we still have many layoff news on the headlines. So PayPal cuts 2,500 jobs, UPS plans 12,000 job cuts, Meta, Amazon, Google, and even Microsoft are cutting jobs. So far in January, 23,500 jobs were terminated. I mean, even more than that. And the ADP report, which is due today, is expected to print a fairly soft 145,000 new private job additions in January. A part of the technology layoffs is the scaling back of the exaggerated pandemic hiring, mind you, but that actually doesn't explain the whole story. Because some now believe that many technology companies are now cutting jobs in areas that are not really successful to increase focus in AI-related areas and units. So it's not AI per se that is stealing jobs, but for now it is the race to develop AI and stay in this relentless race that is stealing people's jobs. So speaking of AI, Microsoft released its latest quarterly results after the bell yesterday. Both earnings and revenue was better than expected by analysts. Microsoft's cloud unit, Azure, made 30% more last quarter compared to the final quarter of the year before, where OpenAI was not yet part of our lives. Microsoft's results overshadowed Google's cloud business, which grew only by 24% more than the same time a year earlier. But there's always a but. Microsoft's stock fell up to 2% in the after hours trading because the company gave a light quarterly outlook. So it actually matched by anything less than mind-blowing is considered as being weak reasoning at the current price levels and valuations. So in this respect, some profit taking in Microsoft and elsewhere in big technology stocks is perhaps on today's menu, because Google fell almost 6% and AMD fell more than 6% in the after hours trading yesterday after their results failed to match the market expectations as well. So the question is this the beginning of profit taking and correction for big tech stocks? Well, it could be. The S&P 500 has been running from record to record this January, and that's mostly due to the extension of this big technology rally on AI. Mama stocks are up by more than 10% since the beginning of this January. And Nvidia, which became the icon of the AI rally and which hit a fresh record high yesterday, yet again is up by almost 35% since the beginning of this month, because investors have been piling into these technology stocks, and that despite the overbought market conditions and despite the overstretched market valuation. So the earnings misstep could well be that trigger for some long-awaited profit taking across these US big technology stocks. And if that's the case, well, even a soft Federal Reserve stance could hardly make investors feel better, because bear in mind that the technology stocks in the US, which were initially supposed to be sensitive to the Federal Reserve rates, mostly ignored the higher rates last year throughout the year because AI overshadowed every piece of economic news and rate news. So a profit taking could come even with prospects of softer financial conditions in the US moving forward, I'm telling you. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful. and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.